What happened in real estate in 2019 and where are we going in 2020? Stick around and find out. Hi, I'm Gordon Baker with the RE/MAX Alliance Group, and today we're going to be talking about prices, inventory, demand, foreclosures, and how to compete in this crazy market. So get ready. Now, the dominant theme when you look at the market in 2019 and going forward in 2020 is there are fewer homes for sale. So let's look at the beginning of 2020. As of January 1st, 2020, the available resale listings is 11,135. Compare this to January 1st of 2019, where it was 16,293. That's a 32% drop. Now, this lack of inventory has benefited new home builders. As you can see, the numbers for new home sales has increased year over year. And this decreasing supply of homes has been a major contributor, if not the most significant, to increasing prices, where the median home price is now close to $300,000. Let's try and put into perspective the balance between supply and demand. Suppose no more houses came on the market. How many months would it take for those homes currently on the market to sell at the current demand rate? That's called the months of supply. It compares the supply with the demand. It's now approaching 2 months, ending a year significantly lower than the previous one. Now remember, this is an average of all price ranges. So let's dig down and look at the months of supply by specific price range. And if you're considering selling your home, this can give you a good idea of how long it will take to sell your home if it's in acceptable condition and priced right. Besides the cost of buying a home increasing, let's look at the cost of renting a home. Since 2014, the cost of renting has increased about 7% per year. This might be a good time to step back and compare the cost of renting versus buying in case you're in a position where you can consider both options. So let's look at a $300,000 home purchase with 5% or $15,000 down at a 4.5% interest rate. The principal and interest will be $1,444 and will include $171 for private mortgage insurance or PMI and $185 for taxes and insurance. This brings the total monthly payment to $1,800. If you look at the current properties for rent, depending on the location, a good estimate is going to be around $1,750. And remember, rental rates have been increasing at around 7% per year. So you save a little bit by renting, but look what happens after 5 years. The $285,000 loan principal has dropped to $260,000, roughly $5,000 per year. So the $15,000 equity has now grown to $40,000 before any appreciation. A modest 2% appreciation will add $31,000 for a total equity of $71,000 after 5 years. Let's look at why the demand in the Phoenix area is so strong. Consider this chart from Fannie Mae, which shows the primary reasons why people might consider it to be a good time to buy a home. First, favorable interest rates that continue to be at historic lows are a major contributor to the current demand, and favorable economic conditions experienced in the nation and also in Arizona. Now, specifically to Arizona, we should add low property taxes, especially when compared to California and the East Coast. And Arizona has a positive net migration. Arizona is consistently ranked in the top 5 for growth, and Maricopa County just a couple of years ago was ranked the fastest growing county in the U.S., adding over 200 people per day. And as we mentioned, rising rental rates also make buying a home a viable alternative. At this point, a valid question would be, are we going to have another crash? Well, no, not like the previous one, and let me tell you why. When a homeowner falls months behind on their mortgage, the bank will issue what's called a notice of trustee sale, giving notice to the homeowner that a foreclosure will occur in 90 days. This always happens before the actual foreclosure. Look at how many notices were given during the crash when anyone could get a loan. Look at where we are right now, a much better situation in place after tighter lending restrictions were implemented to correct the shenanigans, and that's putting it mildly, that were taking place. So the number of distress sales, both foreclosures and short sales, has been decreasing, as you can see in this graph. Could a leveling off or a dip or a slowdown occur? Absolutely, but not like the crash that unfortunately we experienced back in '07 and '08. The numbers just aren't there. So how does a buyer compete in this seller-friendly environment? Obviously, cash is best, but not a possibility for all buyers. So let's look at the likelihood that you'll be competing with a cash offer. According to this graph, 20% of the purchases are cash. So remember, 1 in 5 offers will be. The good news is 80% still are financed, so be persistent and make your offer as attractive as possible, which means don't ask for seller concessions unless they're absolutely necessary and limit them where possible. Asking for 2 to 3% closing costs from the seller is a big hurdle in this environment. Keep in mind that on a medium-priced home, this is asking the seller for an instant reduction of $6,000 to $9,000. In a competitive market on a hot property, that will be a stumbling block, unless the home has been on the market for a while and then you could pull it off. Don't ask for the piddly stuff. For example, in the HOA addendum, you might have a $75 transfer fee. Go ahead and pay that. The appearance that you're trying to be equitable and fair is worth much more than that small transfer fee. An offer with a contingency to sell or lease a property is a disadvantage. It introduces more risk into the transaction, and in a competitive market on an appealing property, it will make it that much more difficult. However, if the property has been on the market for a while, isn't moving, with a good offer, you might be able to make it possible. Offer flexibility where you can, such as in the close of escrow. It may not be always just about the price. Talk to the seller and see what their needs are and tailor your offer accordingly. Well, this has been a short or not so short review of what's happened in 2019 and how 2020 has started off. I would like to hear your comments about the market, and if you think this has been informative, like it and subscribe to make sure that you receive future real estate updates. And if you have any questions about real estate or have any real estate needs, please don't hesitate to reach out to me at 480-326-8571. Thank you.